Good morning, everyone. I'm Louisa Savage, Editorial Director of Washington Post Intelligence, and I'm so glad you're here. If this is your first time joining us, welcome to what I like to think of as our weekly strategic huddle. This is where we step back from the noise of the headlines and focus on the signals that actually matter for leaders like you, whether you're running a business, shaping policy, or navigating global markets. We are building something new here. Washington Post Intelligence isn't traditional media. It's a premium analysis service built for decision makers and shaped by your feedback. So, whether you ask us questions in this chat or over our coffee later, that guides our reporting. And my email's on your screen, and I'd love to hear from you. A quick reminder about what your WP Intelligence subscription unlocks: weekly intelligence reports that are written like high-level cables with actionable insights, in-depth interviews with decision makers and insiders, a Friday newsletter to share with your teams, a new downloadable graphics library to brief stakeholders visually, and of course, these live briefings. We want this hour to feel like your appointment viewing, a rare space where policymakers, executives, and analysts are in one room together thinking out loud. So please jump in with your questions, challenge us, tell us what you'd like to see next. This is your platform as much as ours. And today we're talking about the new policy landscape around U.S. investments in China. And we have two great minds to walk us through it and what it all means for business and markets. Josh Rogin is our lead global security analyst, and he has recently published a detailed report that you can read on our platform on this very topic. Josh has also spent much of his week focused on potty training. So for those of you who'd like, he can hold a whole entire separate briefing on that later. And we're also very happy to welcome Chris Iacovella, Chief Executive Officer of the American Securities Association, which is a trade association that exclusively represents the wealth management and capital markets interests of regional financial services firms. And he also has deep and recent experience in potty training. So I think that briefing is going to come together soon. But thank you both so much for being here. Great to be with you. And so here's how we'll organize our conversation. First, we're going to talk about some of the seemingly contradictory signals that we've been seeing from the Trump administration around investment in China, and what we expect next from the White House and executive agencies like the SEC. Second, we'll talk about moves that are brewing in the Congress. And third, we'll talk about how companies and investors are responding, and we'll discuss some detailed recommendations for how best to position yourself in this new environment. And I'd like to thank everyone in the audience who sent us questions when they RSVP'd ahead of the briefing. We have used them to help shape this conversation. And throughout our chat, I'll invite you to drop your questions in the chat, and we'll take relevant questions as we go along. We'll also reserve some time toward the end of the briefing for additional questions. So with that, let's dive right in and talk about the America First investment policy. Josh, let's go back to February. The Trump administration came in with a loud pronouncement that they were going to do this America First investment strategy. Walk us through what this policy was and where does it stand right now with this White House?
Thanks so much, Louisa. Thanks, everyone, for joining us today. The Trump administration, when it came in, was actually set on reinforcing an initiative that was started by President Biden in August 2023. The Biden administration issued an executive order that would establish new rules and regulations to govern and monitor, and in some cases restrict, the flow of U.S. capital investment from the United States to China in key industries that are important to our national security, specifically artificial intelligence, quantum computing, and semiconductors. And what's interesting about that is that the Biden-era executive order didn't actually get implemented, didn't actually come into effect until January 5th, just less than 3 weeks before the Biden administration left. So when the Trump administration came in and signaled that it was going to pick up that ball and run with it, that seemed like a pretty significant sign. And in fact, the American First investment policy, as it's written, would greatly expand those rules, and it would strengthen these restrictions, but also strengthen the Committee on Foreign Investment in the United States and its ability to prevent Chinese investments in the United States that were problematic for national security reasons. And it would also have created a fast-track process to help the United States speed ahead in these industries with foreign partners that are not problematic, probably mostly from partner countries, mostly in the Persian Gulf. So this policy was pretty well thought out, it seems, but then it's been pretty clear since February that not much of it has been implemented. And we're going to talk about why, but one of the main reasons is that the directorate inside the National Security Council on national security and technology, as it relates to China, was dissolved in April, and its staff was largely laid off. And then we also saw sort of a shift in the administration's policy toward a more cooperative and even engagement-focused approach toward Beijing as President Trump engaged in first tariffs and then negotiations over a larger trade deal. This policy has been, quote unquote, orphaned now in the administration, according to my sources. Nevertheless, there's still a lot of momentum in Congress that we're going to talk about later, and momentum inside the government for doing what the original intention was, namely to figure out which parts of the Chinese economy are connected to their civil military fusion program, and then cut off the flow of U.S. funds to those industries so that we're not putting American investors in the position of funding the machine that's pointed against us, and we're not helping our greatest adversary advance in technology ahead of us that eventually will redound to our negative national security and economic interests.
Right. So that goal, that purpose of this policy seems very consistent with where this White House has been from the very beginning in terms of its views on China, its views on American competitiveness, and its views on treating China as a rival and a potential, adversary militarily. So all of that made sense. But then some CEOs came in and met with the White House, and suddenly NVIDIA was allowed to sell its powerful AI chips to China. It felt like the pendulum had swung in one direction and then the other. So, Josh, you published a recent report that tried to make sense of these contradictions and sort of lay out where we're headed. So what is your sort of overarching takeaway from this report of why the administration changed gears, or has it changed gears?
I think it definitely has changed gears, Louisa. And essentially what President Trump and Commerce Secretary Lutnick have done is they've created a precedent with that NVIDIA deal where any national security concern, especially related to China, can be jettisoned in exchange for a deal. And in the NVIDIA case, it was a deal for profits of their sales of advanced semiconductor chips to China. And no matter, some people will say, well, it's not that much of a national security concern, but either way, the idea that we're going to charge a fee for export licenses or exemptions from export restrictions is brand new, and many would argue unconstitutional, and many would argue sets a bad precedent that any national security concern can be traded away for the right price. And that's what's happened. The CEOs and some more China-friendly officials inside the administration, namely White House AI czar David Sachs and others, have completely turned the president in a different direction when it comes to the idea of technological cooperation with China. And it's very clear that this NVIDIA deal is just the first of many to come.
Mm-hmm. Chris, how do you see it? Where are we on this pendulum of the investment policy with this administration?
I think Josh, in his piece, pointed out something that's very important to the implementation of the policy, and that's personnel. And, the administration is waiting and has been waiting for a while to have all of its folks in the places that are necessary in order to implement the varying pieces of the investment policy that was put forth. And so, where it's moving along slowly, I think you're going to get somebody in Treasury and investment security, and you'll get some of the other positions filled. And over time, that will allow folks to get in there, analyze what's happening, put forth recommendations to the Treasury Secretary, to the Commerce Secretary, to the National Security Council, and start to work all in sync together to implement the policy. But when you don't have those positions filled because of delays in confirmations, it's hard to do that and everybody get on the same page. And then you have a situation where the policies and the trade tactics can they all flow up to the president, and not all of the information is being vetted thoroughly through the departments, because you don't have the people in there whose task and whose daily job it is to do that, putting forth memos and information so that all of the best decisions can be made based upon that information. So I think that's really important, and Josh pinpointed that very accurately.
So, Chris, what kind of a timeline are we looking at then for those seats to be filled? And if you're correct, for this policy then to start being implemented in a more robust way?
I think the seats will be filled probably within the next 6 weeks, based upon what we saw from Senator Thune recently, saying that it's time to move forward with these nominees, and if no deal can be struck, we're just going to push them through. So you can expect those seats to be filled, and that should lead to more robust engagement with the industry, with the Chinese Communist Party, with the White House through the end of the year, and certainly into the first quarter. I think this is all part of a grander scheme, as Josh suggests, but I do think that there's a lot of levers that can be pulled, and the investment policy lever is one that can be pulled, and that is a very big one that the Chinese are hoping doesn't hit them in a way that would negatively impact American dollars going into their economy, and the president can pull that lever whenever he wants to.
Mm-hmm. And speaking of the administration, one important part of the executive branch that's involved here is the SEC, the Securities Exchange Commission. They're considering a new rule that could be relevant here. Chris, can you walk us through what the SEC is considering?
I think they're considering a number of options. Chair Atkins came into the position. He was asked about this in his confirmation hearings. He's received multiple letters from members of Congress on both sides of the aisle about their concerns related to the outbound investment into China and into Chinese companies in our marketplace. And one of his first steps that he's taken is to reevaluate what the definition of a foreign private issuer is, the FPI definition, a foreign public issuer. I'm sorry. What that generally is, for your audience, is it's a company that is outside of the United States that wishes to issue securities into the United States market and be listed on an American exchange. Think about Alibaba, think about Royal Dutch Shell. There are a number of companies that fit that bill that wanted access to the American investor into our deep and liquid capital markets. And over time, that was designed to allow developed market companies to have their companies and their markets come in to our country, have comparable regulation as it related to the home country, such as Canada, the UK, France, Europe, other places, where there was a reasonable oversight, comparable transparency, comparable accounting standards, and you would allow them to come into our marketplace with some reductions in what it is that they had to comply with based upon differences, and you could rely on the home country regulator to make sure that the company wasn't acting in a manner that would be harmful to American investors or to investors in that country. That's not the case with China. And the Chinese abuse this process using a variable interest entity corporate form, which is essentially a blocker corporation that has been set up in the Cayman Islands so that there is no recourse legally for an American investor to be able to get to the Chinese company that's headquartered in mainland China in the event of fraud, in the event that President Xi decides that the useful life of the company is over and he wants to extract revenue from the company. In the event that insiders decide to bail on the company and sell their stock, there's no recourse. What you have is a share of a contract in a Cayman Islands company that acts as a blocker for the mainland Chinese company. And Paul Atkins has rightly identified that as a problem and not an abuse of what the foreign public issuer was supposed to be, which was to have a comparable regulatory jurisdiction who would monitor companies in the market and abide by similar rules as those put forth in the United States. And so he's put out a release, and we expect him to put out a formal proposal that would really target the use of the VIE structure and its corporate legal form in our country.
Mm-hmm. And so, if I understand you correctly, then the SEC, they're less concerned about where the money's going, and they're more concerned about protections for investors on U.S. exchanges, given these kind of harder to keep accountable corporate entities that are being set up.
Exactly. And this has, been part and parcel for the concern that I've had and Josh has had over the course of the last 10 years is that the SEC is a disclosure-based regulator. It's not a national security regulator. And unless Congress or the executive tell them to delist specific entities from the US capital markets, they're reluctant to do so. And so this move by Chairman Atkins is a very aggressive move to take a look at whether or not this VIE structure conforms to the mission of the SEC, which is to protect investors, promote capital formation, and maintain fair and efficient markets. And clearly, Congress in 1933 didn't want to promote capital formation in China. You can't protect investors if they have no legal recourse against an entity that could be fraudulent or could pull the rug out from investors from a disclosure, transparency, accounting standpoint at any moment. And certainly that impugns the integrity of our marketplace when you have companies like that trading in our market as compared to American companies who have to comply with very stringent rules and regulations in order to stay listed in our markets.
Gotcha. Is this a very common form, or are there just a few of these companies, or are there lots of them?
This is the form that every Chinese company takes in our marketplace.
Gotcha. So it has a big significance. Josh, several national security and political questions for you from our audience. We have one audience question asking, with tightening restrictions on doing business with China, will President Trump seek more opportunities to grant exceptions on a case-by-case basis, especially if the government stands to profit from the exempted transaction? So I wonder what you think. Is NVIDIA just the first of many?
Yes, I think it is. I think what Chris said about the personnel changes is spot on. I think what we're seeing now beneath the surface is a pitched battle over some of these key positions inside the national security bureaucracy. For example, just yesterday, the administration withdrew its nomination of a man named Landon Head, I'm not sure, to be the Assistant Secretary of Commerce for the Bureau of Industry and Security. And that's a blow to the China hawks inside the administration. He was previously working at the NSC directorate that was in charge of this America First investment policy before it was dissolved. And that was seen as a clear move by other people in the White House who are more supportive of this China investment cooperation approach to make sure that the Commerce Department, the Treasury Department, the NSC doesn't have a strong presence of officials who want to increase the restrictions on China. And the reason that they want to do that is because they want to have less people to raise their hand and object the next time a CEO comes into the White House and says, I'll give you X money for this national security provision to be exempted. And we're going to see that, I think, across the board. And in addition to the stake that the Trump White House forced Intel to give them, I think that's a precedent that we'll see more equity plays. Commerce Secretary Howard Lutnick has said that he's going to look at defense contractors. I can tell you from my own reporting that meetings have already begun between the Defense Department and the Commerce Department about how to approach defense contractors to shake them down for pieces of equity. And patent holders are next. Any government research that funded any patent, those entities, research entities or companies, universities, could be called to the carpet to pay some sort of fee or some sort of tax, whatever the White House thinks of. And this is all building up to the building of what Commerce Secretary Lutnick calls a national security and economic fund. Some people call it a sovereign wealth fund. And this is the big idea. This is what all of this money is going for, to some sort of fund that will be at the president's discretion to use for, I don't know, national security purposes, political purposes, patronage purposes, all of the above.
Yeah, and I will remind our audience, we do have an entire report that Josh wrote on this topic that's available on our platform. There's one other national security question for you, Josh, related to this. What is the possibility of the NVIDIA chips that China can now buy going first to Russia and then Iran?
Sure. I mean, I think there are lots of ways that advanced technology is getting into the hands of adversaries. And, what people who are on the pro NVIDIA side will say as well, we can't keep these things from going anywhere, so we shouldn't try. But I think that sort of abandons the whole idea of having national security restrictions. So, it's a cat and mouse game. I think that China supplies Russia and Iran with lots of things, and diplomatic, economic, military, you name it, material. And this is only one thing. But, I think what we saw was that, first of all, before the chip exemption was put into place, somehow the Chinese companies still got the chips, okay? And that means that the enforcement wasn't up to snuff. And then after we allowed them to have the chips, well, somehow they decided that the chips were a national security threat. So what we're seeing essentially is a reshaping of supply chains around both the new tariff regimes, which are meant to crack down on this, what they call transshipment, the idea that you sell to Singapore and somehow the chips end up in China. But I don't think people are necessarily focused on transshipment from China of chips to Russia per se. Nevertheless, there's a lot of funny business going on between those two economies that we just don't have any good eye on. And the more that we relax these restrictions, the more shenanigans we're going to see for sure.
Yeah, well, so that's a great segue, since there are a lot of people in Congress concerned about this issue. Talk to us about what is happening in Congress. You've been following a couple of things that are brewing there on this issue.
Right. So this whole idea of enshrining and elevating and strengthening outbound investment restrictions on China still has very strong bipartisan support in both chambers. And at the end of 2024, there was something called the Coins Act, which almost passed. It got stripped out of the budget bill at the very last minute, but it had been endorsed by Speaker Johnson and by Chuck Schumer, and it was almost there. So they're going to try this again. And in the Senate, it's led by Senators Cornyn and Cortez Masto, and in the House, it's led by Representative Andy Barr. And they have versions of these bills. And it's really hard to pass a bill through the regular process these days, but the idea that they have is to attach it to another must-pass spending bill. The next one up is the National Defense Authorization Act. That could be it. It could be a big budget bill. But anyway, Republicans, Democrats are not going to stop just because the administration doesn't seem enthusiastic about it. And the real question I think that everyone has on Capitol Hill is when that effort is about to succeed, is the White House going to come in and say, hey, wait a second, we've got this meeting with Xi Jinping coming up, or we've got these trade negotiations that are delicate. Tap the brakes on this whole outbound investment restriction drive until we get that sorted out. I think that's what a lot of people are expecting, but we won't know. Nobody will know until that bill actually reaches the point of almost getting passed, which should be sometime this year, I think.
Mm-hmm. Chris, what are you hearing in your conversations on the Hill?
I think that's Josh is exactly spot on. And, what these bills do is they hit the areas that Josh spoke about earlier: quantum computing, artificial intelligence, trying to get to the core of the military industrial technology complex that is China, and prevent VC investment, prevent private equity investment, prevent American investors from the retail side from investing in those companies. And what the bills generally do is they would be broad prohibitions on those sectors, and then still consolidate power within the Treasury Secretary to be able to, at his discretion, implement sanctions as they see fit or necessary to prevent money from flowing to any other Chinese CCP controlled company or company linked to the military industrial complex that might not be on one of the various entity lists across the government. And so, we're very supportive of that bill. I testified earlier in the year in support of those bills. We also are very supportive of the public and people on this call and the investor base understanding what Chinese companies are in our capital markets today that are on the various entity lists. I think that there's a disconnect because there are so many different lists. There's a State Department list, a Defense Department list, a Commerce list, and not everybody knows what companies are on these lists, and then they either are doing business with these folks or they're part of ETFs or exchange traded funds or mutual funds, and they shouldn't be there because they're either a threat to our national security if you're on the DoD list, a threat to our foreign policy or our national security interests with the commerce list. There are human rights violators or contributing to human rights violations if you're on the State Department list, and so on. And so it just doesn't make any sense to me that we're sending American money over to an adversary and its progenies that are in our markets funding their rise. And so we're hoping that there will be a consolidation of the lists. That's a very easy step Congress can take. You can consolidate that with the Treasury Secretary or the National Security Council. And then that would allow for a much easier policy to happen here in these discussions amongst the different agencies so that we can move a little bit quicker. And you don't have a company like Tencent that goes on the list in January and then nothing's happened, and the Tencent and its affiliates continue to trade in our marketplace.
Josh, you mentioned earlier that there could be pressure on lawmakers to wait out the China trade negotiations, but I mean, those negotiations don't appear to be moving very quickly or have much urgency around them. So how long do you think Congress would realistically wait?
Well, I think for sure Republican leadership will follow the White House's lead in the end. And because we don't know when the trade negotiations are going to wrap up, we can't say how long that will be. But the signals are that as President Trump is planning to head to South Korea for the meeting of APEC leaders in late October, that would be the natural opportunity for him to meet with Xi Jinping. Now, if that meeting happens, I think what we'll see is some progress in the negotiations, but not a resolution of those negotiations. So in a sense, it might actually make the competitive and harsh measures against China, especially in this area, even harder for Congress to pass. But then again, President Trump's pretty unpredictable. And, I'm old enough to remember the first Trump term when he was best friends with Xi Jinping, and then he wasn't, and then he was again, and then he wasn't. And then they had engagement and then pressure, and then they made a deal, and then COVID came and the deal unraveled. So, I think the stance of Congress and both parties is just to be ready to do it when the window for doing it opens, which it surely will at some point in the kind of unpredictable nature that we see. And meanwhile, I think what Chris is talking about, which is the risk for companies, still keeps going up because, we have all of these restrictions in different parts of the government in place that are either not enforced or not being followed. But nevertheless, eventually, these companies will face that risk, and whether or not they think the administration is going to be tough on China this year or the next, over the long term, those risks are going in one direction, and I think that's the general sense in Congress as well. Like, this may not get done soon, but it will get done.
Mm-hmm. So let's talk about the risk and how to manage it. First, there's like a bigger picture risk question that we have from the audience. And it says, could we see retaliatory measures from Beijing levied against existing U.S. capital investments in China, including indirect or direct expropriation of assets? Maybe both of you could weigh in, starting with Josh.
Sure. No, I think we already see and have seen the Chinese government and the Chinese Communist Party exert all sorts of crazy pressures on U.S. and other foreign businesses doing business in China or investing in China for a long time, and they're only getting worse. And they have a few different characteristics. One is where, a company that has a market base in China can be pressured to do almost anything that's in the party's political interest under the threat of a boycott. We saw that with a company like Nike, for example, or H&M that dared to contradict the party political line, and all of a sudden 40% of their business in China vanishes in a day. We've seen the arrest and detainment of American and local staff hired by American companies and other foreign nationals for whatever reason. Companies that were doing economic research or publishing data that the Chinese government didn't like, they could see their people scooped up and thrown in jail for no good reason. So that's a thing. When it comes to the money, well, yeah, if you're heavily invested in any of these Chinese companies, there's no assurance that you can get that money out of those companies at any time. And the Chinese government can nationalize those companies. They can just keep the money. They can tell them what to do and what not to do. Now, it's kind of funny because now we're moving in that direction with our government and our companies, but we're not nearly to the point where the Chinese Communist Party is, where they literally appropriate or jail or nationalize any entity at any time for any reason with no notice. So that's a pretty broad and high level of risks. And, I think, again, investors kind of know that. And I think even if whether you're NVIDIA or you're one of these Wall Street firms that's doing it anyway, your calculation is that you can make some short-term profits until you either get pushed out of the market, or, your investment blows up, or the tide turns again. And I think there's a lot of short-term profit taking that ignores a lot of long-term risk. That's good for the short-term profit-taking people, but really bad for the Americans who are invested in these companies, and bad for our national security as well, if you care about that kind of thing.
Chris, what do you think about this notion of retaliatory measures? Should we expect Beijing to retaliate if Washington starts cracking down on U.S. investment in Chinese entities?
Absolutely. I think it's a very real risk. It's something that we've been raising the flag on for a number of months now, and even in the first Trump administration. U.S. multinationals that do business in China have money that they make in China, and they can't take that money out of China. That's on the books. It's reflected in their earnings. It's reflected in their stock price, but they can't move that money. And I think that if you're talking about a retaliation, the first place that you would go would be the U.S. multinational companies that have businesses in China, and you would restrict them from taking any of that money out permanently, or you would actually appropriate the money in those companies. And that is a very real risk to the everyday American investor. It cuts across big tech, big Wall Street, every single company that's over there, Starbucks, Nike, retail. I mean, you name it. And these companies have an exposure, and their investors have an exposure that people haven't contemplated. That kind of a shock to the American market would send the stock market down and keep it down for a very long time until the political tensions were eased or there was some resolution. And that's a lever that Xi can pull, and he can pull it at any time, whether he does it in conjunction with an aggressive action towards Taiwan, a blockade, or any other kind of action, or he can do it as part of his leverage to show President Trump that he has leverage too in the trade negotiations. And, they can do this by leaning on American companies. They can do it the way that Josh just discussed, by arresting people. They can go into offices. In all of these multinationals, there's CCP cells in these companies. So, again, our point has always been, and my point throughout the last 10 years, is why are we funding an adversary? Why do we continue to do business with an adversary? I realize it's a very large marketplace, but you don't need to do business over there and expose American investors to this kind of risk simply to put cheap goods on the shelf here.
So I want to invite our audience to send in your questions on the topic of risk management, especially. Josh, you put together this whole report where you talk to people all over the industry and in policy, and you ask them for their recommendations on how companies, investors should protect themselves, given, as you said, that the regulation is going to go in one direction going forward. So where should companies start in their risk management?
Yeah, recalculate your risk management up. That's plan for because you can't really know where the policy is going to go, but you know that in the United States, but you can be pretty sure that in China it's going to get worse. The business environment is going to get worse. If you look at Hong Kong, it's just worse. If you look at sort of, despite what we see from some sort of, corporate outreach and corporate invitations from the Chinese government that they're open for business, over the long term, it's pretty clear that their markets are closing. The Americans companies that have been successful in a brick and mortar sense are getting copied and then pushed out. The companies that enter into joint ventures are having their IP stolen and then they're getting pushed out. And frankly, the Chinese are surpassing the United States in many areas of frontier technology and innovation, including energy technology, battery technology. They're competitive on AI and the like. So the idea that we could, for example, as NVIDIA leadership would say that, well, if we just give China all of the money and technology that we have, we'll keep them addicted to our technology, and that will be better for our industries. I think hasn't borne out, and I think is very unlikely to bear out, according to the experts and officials that I talk to, and that I think are right about this. And what that means is that we can't slow down Chinese innovation, but we can protect ourselves, and we can understand that even if we have an engagement strategy, their strategy is adversarial, and we have to deal with that both on a government level, on a congressional level, and on a corporate level. So it's not to follow sort of the ups and downs of the Trump administration trade negotiations as much as you follow what's going on the Chinese side, and that will give you a much better picture of the risk. And again, that risk is over time is headed in one direction, and that's not good for American businesses.
Chris, you laid out for us in some detail what the SEC is concerned about and what they could be doing on FPIs and VIEs. Can you talk about how companies should prepare for those moves?
Yeah, I think investors at the institutional level, at the pension level, at the retail level, need to look at their portfolios and see what their China exposure is. There is no need for them to take on China risk right now. As Josh said, you have a two-way risk. You have the risk that the United States is going to actually implement sanctions, delist, take all of these companies on various entity lists off of our marketplace. You have the regulatory risk associated with the SEC moving to protect investors in a very forceful way. And then you have the risk that G is unpredictable, could appropriate funds, could appropriate shareholder wealth, use that as a form of leverage in a trade negotiation. So my advice to any fiduciary that's out there is to really reevaluate what it is that you're holding, what your China risk is, not just direct through Chinese companies, but also through multinationals. You have power. You can use shareholder proposals. You can speak with management. You can ask them what would happen to the capital that they have in China in the event that there is an adverse circumstance imposed by the CCP on their China-based business. And for retail investors, the best thing to do would be to look at your portfolio and make sure it's China free. And at the end of the day, we talk about trade, we talk about investment, but there's a reason why your retailers and others continue to do business in China, and that's because they don't have environmental laws, they don't have labor laws, they don't have health and safety laws, and in some cases they use slave labor. So as American citizens, the fact that the Chinese goods are always going to come in here cheaper, you have to start to evaluate, why is that? Why is this difference happening? And what is this competitive advantage? And why do we continue to fund an adversary that doesn't play by basic rules of international trade?
Yeah, and I would just add one more thing to that. Even though right now we see that the trade negotiations are ongoing and the Trump White House seems pretty intent on leaning toward improving the relationship with Beijing, what we have in the meanwhile are 60% roughly tariffs, which are higher on most Chinese goods, which are a lot higher than they've ever been before. A lot less than 145% for those 3 weeks or whatever, but 60% across the baseline. That's not going to go away, even in the scenario where they make a further extension of the trade negotiations that leads into next year. That's still 60% tariffs, and there will be real supply chain reorientation, restructuring based on the realization that those are going to be structural tariffs, at least for the next year or two. And then the second thing is that the Trump administration took away a privilege for shipping Chinese goods that's known as the de minimis exemption, which basically said that any package coming into the United States under a certain threshold wouldn't have to be tariffed or taxed, and a ton of Chinese goods come in through that. So those goods are going to become more expensive, and the incentive for doing business in China in those industries is going to go down. So even though we don't have any resolution, I think if you look at those two particular impacts of the current policy, you can see that the calculation for businesses who are doing their manufacturing in China or depending on China for any part of their supply chains has already changed and should be changing.
Josh, we talked earlier about the impact that CEOs had on the president after a few one-on-one meetings. We have a question here in the chat. Is there space for business to dialogue directly with Communist Party of China officials about its concerns?
Oh, for sure. No, there's nothing the officials in Beijing love more than hosting foreign businessmen. And right now that's sort of a counter prevailing trend to what's going on in Washington, because what will essentially happen is that a senior U.S. official, or even the president, or maybe a back channel official, somebody, a name that who's connected to the Treasury Secretary, the Commerce Secretary, will go to Beijing with dozens of CEOs in tow. And I think those relationships are actually quite robust. So it's if you want to go ahead and meet with the Chinese officials, that's a very easy thing to do, and I'm sure there's benefits to that. In fact, again, short-term gain, long-term risk. That's the calculation. But I think what you'll see there is that there for some businesses that will make a lot of sense, and for a lot of other businesses it will make no sense at all. And for the Wall Street firms, especially, they're the ones heavily connected, especially the Blackstone, BlackRock, Goldman, you name it. Okay, those are the ones that are most active both inside the negotiations and outside the negotiations, and pushing for an outcome where the U.S. and Chinese financial, economic, and technological systems are more intertwined. In other words, either you believe that we're going to head towards a future where the United States and China are going to be merged technologically and economically, or you believe that we're headed towards a future where we're going to be increasingly decoupled. Okay, and these are the two essential, fundamental competing visions, both inside the United States business community and inside the administration. And I don't want to speak for this. I tend to believe that the latter is the case, not because decoupling is necessarily better, but because that's the way essentially the Chinese government is also thinking about it. And they're decoupling from us while we're decoupling from them. And sure, there is some cash to be made in engaging right now, but the long-term trend is pretty clear. Nevertheless, you'll find a lot of people inside this administration and inside these Wall Street firms who don't think that way. And for them, engaging with the Chinese government is the best way that they can make the most money in the shortest amount of time. And it does work. It doesn't solve any of the problems that we're talking about today, but it is very possible to do if that's what you're into.
Chris, is that your view too, that we're heading for increased decoupling?
Yes, I absolutely believe that. I think it's necessary. The Chinese need access to the U.S. consumer because we are a debt-based consumer, and they need to sell us goods. And what they're seeing is that we have a president, and I wouldn't just say a president. I think it's a broad-based bipartisan consensus that the Chinese Communist Party is a problem. Now, the business community continues to want to extract as much profitability as they possibly can from this relationship, but the relationship is inevitably heading towards a break, and it has to. I think the tariffs were one portion. You have what we are hoping is going to be a restriction on outbound investment, a restriction on investment by Chinese into the United States, and we're going to enter into a period where there's a balkanization that directs international global trade and international financial markets. And I think that's exactly where we're headed. And investors need to understand that dynamic and not think that this is the status quo. And at some point, Wall Street is going to have to go the other way. And it all depends on how the negotiations between Xi and Trump go. And at any given moment, they can go the wrong way. And Wall Street and its multiple investments in China are going to be worth nothing.
Well, I want to ask both of you your assessment here because we have these competing pressures. We've got the national security issues. We have the constant talk about wanting to keep the edge in the technological race with AI. The administration's super focused on that. On the other hand, this is a president who's very aware of the stock market, very concerned about not crashing the stock market. I mean, what you're describing as this complete decoupling would and kind of trading off these profits would presumably have a negative impact on the stock market. He's trying to make a deal with Xi Jinping. On the other hand, he's saber rattling at the same time. So there are these countervailing pressures. If you were to just take a step back, how are you assessing where this administration is? How do you think about it, Josh? Because you've been following so many pieces of U.S. policy towards China, but how do you assess the big picture?
Yeah, it's a great question because I think unlike most of the other relationships that the administration is engaged in, the U.S.-China relationship is firmly right now in the hands of the Treasury Department. And that's not only different from all of the other trading negotiations, which are largely in the hands of either the White House or the Commerce Department or the U.S. Trade Representative's office. The fact that Treasury Secretary Scott Bessent has been handed this ball and seems to be the one directly interacting with the Chinese leadership most often shows you what their big picture stance is. And this is, again, very different from past administrations, too. You have Secretary of State Marco Rubio, lifelong China hawk, wrote legislation related to these very issues we're talking about, led the Congressional Executive Commission on China, very steeped in these issues. That's not the China policy we see. Then you have, the Defense Secretary Hegseth and people like J.D. Vance, who are a different kind of China hawk. They're kind of like, more of an America First China hawk, you could call it. But still on the security side, they believe that we need to have a robust presence for deterrence of Chinese aggression in the Indo-Pacific. They may not believe it's as important as Homeland Security, according to reports about their upcoming national defense strategy. But nevertheless, that's not the China policy that we see. We see the China policy of the Treasury Department, which is very trade-focused, very investment-focused, and very, dismissive, frankly, of all of these sort of national security concerns that we see. And the back channel negotiations are the same. There's a very famous China hand named John Thornton, who I'm told reliably is involved in these negotiations. And, he is very much of the view that economic and technological integration with China is the way to go. So big picture, I think, unlike the first Trump administration, we don't see as much factional infighting because the factions that are want to be tough on China are either a lot of their people got fired, or they're not focused on it, or they're just not willing to stick their head up right now because the president seems very focused on getting a deal done. And I think that's just the environment that we're living in, that we have a very China-friendly policy because of the president's view and because of the Treasury Secretary's view. And how long that lasts is anyone's guess.
Mm-hmm. Chris, would you like to weigh in on that?
Yeah, I think if you take a step back and look earlier in this year, you had Liberation Day, and what followed Liberation Day was Wall Street complaining for days and days and days and days until they pushed the markets down, I think 30%, and then we had the president come back and put a hold on things. And so that was an immediate decoupling. That's what it would look like. And it's clear that that's where we're going, but our economy and our financial markets aren't ready to handle that impact right now. And so I think that what this entire conversation and what Josh and I have been talking about is that, okay, that was the immediate impact, but what's it going to look like over time? Because what you see is the ultimate end goal is a decoupling. So it has to be a little bit slower in order to have the least amount of impact on the United States economy and on the global economy. And so I believe that over time, when the personnel is in place, as Congress continues to weigh in throughout the course of the rest of this administration, there's going to be less and less reliance on economic interdependence with the Chinese. There's going to be a lot of people that continue to scream about that, including Wall Street and some of the larger tech and VC voices that have now weighed in that are looking for the short-term benefit that Josh is talking about. But the train is going in the right direction, and it's picking up steam, but it's not going 100 miles an hour ready to smash into a wall like it was in April, but it's still going in the right direction.
Yeah, and Louisa, I would
That's
just say one more quick thing. It is true that President Trump does seem to get rattled when the markets make some sort of drastic move in relation to his foreign policy decisions, but it has to be pretty drastic and a lot more drastic than we would see him react to in the first Trump administration. So that's to say that as long as the markets are relatively positive, I don't think that President Trump is going to take much of that into account. And the markets seem to be relatively positive for a lot of reasons that have nothing to do with China, the tax cuts or the tariff impact wasn't as much as we thought it was going to be, or what have you. But so, there is a point where Trump will respond to market jitters, but it's a really high threshold at this point.
Well, in all of our briefings, I like to take a minute to talk about what's coming next. Josh, do you want to give us a preview of what you'll be covering next week for our subscribers?
Yes, next week we'll have an exclusive and insider report on what happened with the U.S.-Japan trade deal. Two things happened in Japan last week that nobody noticed. They signed the trade deal that they've been negotiating for all this time, and the Japanese Prime Minister announced his resignation. So it's kind of like a good news, bad news situation. So what does that tell us? What does that trade deal, which is one of the first to actually be put to paper, tell us about where we are in the trade wars and where we are in the U.S.-Japan relationship, and how Japan is managing Trump in the second term, which is a complicated and often tragic story, to be honest.
I am so looking forward to that. And Chris, what about you? What are you working on next, and what should our audience be keeping an eye on?
We will be engaging with the SEC and with Congress to continue to move the bar and the Cornyn-Masso bill over the finish line, whether that's getting attached to a must-pass funding bill related to national defense or in a CR, but we will be working on that. There are other China-specific issues. I think there's some angles that can be approached from a tax perspective to try to disincentivize outbound investment into China. And so we're going to be working on that. And then we will also be heavily engaged with Chairman Atkins and the SEC staff as it relates to the VIE structure and investor protection vis-a-vis these Chinese companies.
Well, thank you both so much for your insights. And for our audience, you've been hearing a lot from me and from our analysts and our guests, but I'd like to now introduce an important member of our team that you may have heard from as well in your email. And his name is Brian Shub, and you may have received a couple messages from him. Hi, Brian.
Hey, Louisa.
Brian, you're in New York, and you're here with us today to help our audience discover what we're up to. So what should people be connecting with you on?
Yes, well, I can help with lots of things, whether it's setting up a trial so you can poke around the platform, answering questions about our reporting, or just helping you figure out how WP Intelligence is a fit for your work. I'd love to connect, so please don't hesitate to reach out. My email is down below. You can also just visit wpintelligence.com and drop your information, and I'll personally reach out and walk you through the platform.
Great, thanks so much. And we're just happy to give everyone a face to the name. And in the meantime, please be sure to subscribe to our Friday newsletter at wapo.st/intelligence. You can request a demo by clicking the link on your screen, and Brian will help you out. And please block your calendar for Fridays at 11 Eastern. That's our regular intelligence briefing. Next week, I'll be joined by our lead tech and AI analyst, Jason Dean from San Francisco, and we'll be talking about what every business leader needs to know about the emerging landscape of AI regulation. There's no business out there that isn't touched by AI in some shape or form, and we're seeing a lot of activity at the state level while the federal level pulls back on regulation. And in the meantime, we'll send you a link to a recording of this briefing, and please take a quick look at the short post-briefing survey that we send out. We always read all the answers that you send us, all the suggestions, and we take them all to heart. So thank you so much for engaging with us, and we're looking forward to seeing you next Friday. Have a wonderful weekend.